Are you ready to uncover the secrets of today's rapidly shifting economy?
In this compilation, we feature top analysts like Graham Stephan and Gary Wagner, who delve deep into the market's most pressing trends.
And guess what? We've distilled their expertise into concise AI-powered summaries that save you time.
From actionable investment strategies to predicting market volatility, stay tuned for insights that matter.
First, Graham Stephan will break down why the investment landscape is changing dramatically for 2025. Today, we're exploring how EPB research explains tracking the economy and predicting recessions through their detailed analysis.
They emphasize that understanding the economy requires more than merely data. It needs a framework to connect various economic signals.
According to the framework outlined by EPB research, the economy is categorized into 4 distinct groups: leading, cyclical, aggregate, and lagging.
This segmentation allows for a more nuanced understanding of the economy's movements rather than viewing it as a single entity.
EPB research highlights that the leading economy tracks credit availability and soft commitments, which provide foresight into economic trends.
The cyclical economy measures growth and employment specifically in the construction and manufacturing sectors.
The aggregate economy aims to capture overall health by reviewing total personal consumption and employment.
The lagging economy reflects service consumption once job losses impact these sectors, showcasing a delayed response to economic changes.
EPB research's approach helps in understanding whether to adopt an offensive or defensive investment strategy based on economic conditions.
By tracking the sequence of economic events, they aim to gauge future market movements more accurately.
In conclusion, EPB research illustrates that a well-structured approach to economic tracking is imperative for making informed investment decisions.
They suggest that rather than relying on one indicator, a collective understanding leads to a more dependable forecast of economic conditions.
Today, we're analyzing Graham Stephan's take on the investment landscape in 2025 and what it means for investors.
Graham asserts that 2025 is poised to be a roller coaster for investors, with several key factors influencing market dynamics.
Graham highlights that the political climate in 2025 is drastically different from previous years, creating unique challenges for investors.
He explains that newly enacted tariffs could impact the economy and cause market instability.
Graham notes that many average investors underperform the market due to emotional decision-making.
He cites studies showing the importance of staying invested long-term to maximize gains.
Graham discusses the competitive nature of the housing market and regulatory hurdles affecting availability.
He suggests that while regulatory changes could help, the effects may not be immediate or significant.
Graham predicts that the regulatory environment will evolve, potentially increasing institutional interest in cryptocurrencies.
He emphasizes the importance of patience and dollar-cost averaging in crypto investments.
According to Graham, 2025 could see varied market performance driven by both growth opportunities and geopolitical tensions.
He advocates for staying diversified and resilient amidst these predictions.
Graham concludes that investors must be proactive, preparing for potential volatility and focusing on long-term growth.
He encourages viewers to adopt a diversified approach and remain well-informed.
Today, we're discussing the analysis by Jeff Snider on Eurodollar University regarding the challenges faced in the job market.
Snider highlights significant struggles in various industries, especially automotive, where companies are trying to manage reductions without resorting to layoffs.
Snider points out the dramatic fall in hiring rates, reminiscent of patterns seen in past recessions.
He emphasizes that many companies are utilizing attrition instead of traditional layoffs to address staffing needs.
According to Snider, Nissan intends to reduce shifts while avoiding layoffs altogether.
Similarly, Bridgestone is shutting down a plant while laying off workers due to the challenging economic climate.
Snider discusses the significant drop in consumer confidence, which indicates growing fears regarding job stability.
The lack of new hires further amplifies uncertainties among workers about the future job market.
Snider asserts that the economic challenges are widespread, affecting many sectors facing hiring freezes.
The ongoing drop in job openings underscores the critical condition of the economy.
Snider predicts that stagnation in the labor market will persist as businesses attempt to reconcile workforce sizes with real market conditions.
This suggests a challenging landscape for job seekers in the near future.
In conclusion, as highlighted by Snider, job seekers should navigate this fraught market with caution.
Many employers are modifying their workforce levels through attrition, leaving job security in a fragile state.
Today, we're diving into Gary Wagner's insights on gold prices and inflation, as discussed with David Lin.
Gary explains how inflation affects gold markets, particularly accelerating its performance in high inflation scenarios.
Gary believes that gold benefits from inflationary pressures and outlines prospects for future price rises.
According to Gary, gold's value is closely tied to economic conditions, especially inflation.
What insights does Gary Wagner share about the Federal Reserve's influence on gold prices?
Gary notes that if the Fed continues with rate cuts, gold prices could rise accordingly.
Gary anticipates that potential tariffs could maintain inflationary pressures that benefit gold.
He emphasizes that tariffs may introduce additional inflationary constraints.
What could happen if tensions in global conflicts decrease?
Gary suggests easing geopolitical tensions could lower the risk premium on gold, potentially leading to more subdued price rises.
What are Gary Wagner's predictions for gold prices this year?
Gary forecasts that gold may surpass $3,000 per ounce if current inflation trajectories continue.
Gary advises investors to stay vigilant about inflation data and Fed decisions.
He stresses the importance of comprehending market forces that could drive gold prices notably higher.
Today, Chris McIntosh reviews the surprising shifts in the job market and China's tariff implications.
Chris notes a significant decline in job openings, hinting at potential economic instability.
Chris discusses the unexpected drop in job openings, which have fallen by 556,000.
He emphasizes that the volatile job market may signify deeper economic concerns.
Chris mentions that these tariffs could escalate tensions in critical commodity markets.
Chris highlights that declining job openings may not correlate with employment levels.
So this mismatch suggests a potential hiring freeze in some sectors.
Exactly. Chris warns that further revisions to these figures could bring more uncertainty.
What does Chris say regarding the implications of these tariffs?
Chris suggests that while tariffs may be used for negotiation, they risk a lose-lose outcome.
Chris predicts that economic volatility will lead investors to seek gold as a safe haven.
He projects that gold could reach $3,300 by 2025 if trends continue.
Chris stresses that during uncertain times, investing in commodities like gold is wise.
He highlights Nova Minerals as a noteworthy stock within the mining sector.
Today, we're examining market cycles as analyzed by the technical traders, focusing on the current sentiment and trading trends.
The technical traders discuss how fear has driven some traders to sell off shares, creating potential buying opportunities.
According to the technical traders, current market sentiment is mixed, with some indices showing significant declines.
They suggest that the panic selling could lead to a market rally as price corrections take place.
The technical traders emphasize that fear in the market often creates opportunities for strategic buying.
They believe that panic selling can cause prices to drop significantly, presenting potential buying opportunities.
The technical traders advocate for gold as a solid defensive investment amidst current market uncertainty.
They encourage traders to invest in gold as it has shown resilience, reaching new highs in turbulent times.
The technical traders foresee potential upward market movements, even in light of ongoing volatility.
They caution that any shifts in mass psychology could indicate a significant market top approaching.
In conclusion, the technical traders advise traders to remain vigilant during market sell-offs.
They suggest maintaining a focus on gold investments, given their stability in uncertain market conditions.
Wow, what an insightful discussion we've had today with our expert guests.
Indeed, we've unpacked a lot of critical observations on the current financial landscape.
It's fascinating how all our guests agree on the essential role gold plays as a safety net in these uncertain times.
Right, but there was such a divergence over the job market's impact. Chris struck an alarmist tone while Jeff pointed out specific industry struggles.
And don't forget Gary's bold prediction about gold potentially reaching $3,000. That's quite the confidence.
Absolutely. It's a testament to the high inflation issues we're facing. The differences in opinion really add depth to our understanding.
For those of you watching, if you found these insights as valuable as I did, please give us a thumbs up.
And be sure to subscribe so you never miss out on more expert analyses like this one.
Your support keeps us going, and we can't wait to bring you even more great content.
Next time, we'll explore how global trade dynamics are reshaping the economic landscape. Stay tuned.